Welcome everyone, thanks for joining. In this video, we're gonna be talking about a company called Wix. And more importantly, what we're gonna do in this video is give my view of how I do analysis on companies in general. When I'm looking at potentially buying a piece of a company and sharing a company, I do quite a bit of analysis. I try to look into the details of the company because otherwise I'm just making a guess. And we don't want to make guesses with investments. If you're not willing to do analysis on the companies that you're investing in, I'd rather just put my money into an ETF. That's what I do if I don't want to do the research. So in this video, I'm going to give you an inside look on how I do analysis, the whole thing, kind of beginning to end, how I look at a company. For starters, I break it down into two basic categories. I look at the qualitative aspects of the company, which is what the company is. What are their products? What is their leadership like? What markets are they competing in? Are they markets, first of all, that are in my area of competence, right? Things that I understand and I can actually comprehend what they're doing? Or is it stuff that's outside of my area of competence that I shouldn't even be investigating in the first place? So we look at the qualities of the company and I try to determine first and foremost, what is not going to be relevant in the past or has been relevant in the past, but what is going to be relevant in the future? A lot of investors, a lot of value investors and people that do analysis on companies are so focused on the past. What has the company done in the past? What does their revenue growth look like in the past? What does their previous earnings and PE ratio and net income in the past look like? They don't spend a lot of time trying to figure out what the next year or two is going to look like. And that's something that's incredibly important. That is qualitative research. Looking at the qualities of the company, their moat, their growth opportunities, their total addressable market, the leadership, if they're steering the company with a long-term view. That's the first thing that I look at. The second thing that I look at is the numbers, the quantitative aspect, the fundamental research. We look at the balance sheet, the income statement, the cash flow, and we see after deciding if we want to own the business based off of its qualities, if the price that it's trading at and the market cap that it's trading at is prohibitive, meaning it's too expensive. Even if it's a great company, some of them have raced up into prices that I simply think are prohibitive for an investor. It's just too risky to buy them. So after I try to figure out if I like this company and I want to own it, then I have to figure out if the price makes sense for buying it or whether there's too much risk in it. So that's a simple breakdown of how I do analysis summarized. I first look at the qualities of the company and I try to figure out if it's something that I want to own to begin with. Because there's many companies that I'm not interested in. I don't think they have great futures. And even if they're trading at a simple discount, I still don't want to dive into them. I want to figure out if it's a company that I want to own. And then if I want to own it, I try to figure out if the price makes sense, if I can buy it, or if I'm taking on too much risk and if too much of the future optimism of the company is already priced in. That's the basic summary. So let's go ahead and look at the actual qualities of the business Wix. And again, I want to reemphasize that the reason that I look at the qualities first is because if you don't understand the business, their revenue, how resilient it is, the market opportunity for the company, their growth potential, their marginal cost of replication, if they have a moat, if you don't understand all this stuff with the business, you don't have a clue of what to pay for it. Looking at the balance sheet and looking at the historical numbers does not paint a full picture. And the way that you make assumptions for the future is by looking at the actual business qualities and what they actually do. When I look at Wix, I first ask myself, is this a product or a service that is relevant today that's going to become more relevant tomorrow and next year and the year after that? Or is it a product that's going to become less relevant? Well, if we actually look at what the company does, what it does primarily, it's a fully fledged suite of tools for building a website. So if you want any kind of online presence, whether you are starting a blog or whether you're starting a podcast or a YouTube channel and you want a page for yourself, you can do that for free here. If you want some advanced tools that are for different businesses, you can look at all the different things that they offer. They have drop shipping, order and fulfillment, online stores. They have service and membership-based businesses, online payments, point of sale, multi-channel, so on and so forth. They actually have different categories of business templates. You can have things like restaurants, hotels, photography, music, events, fitness, and they have different tools and integration specifically made for each of those industries. For instance, there are, I think, over 1 million restaurants in the US. It's a huge business. If you wanted to create a restaurant website and you didn't know how to code and that's not your business, you don't want to hire a programmer, you can go into Wix, you can click on restaurants, and then it will give you all the tools to do that specifically for a restaurant. It'll have specific things like a menu builder for your menu, where you can plug in everything and they have a nice little tool just for the menu. They have integrations with all the booking apps that you can have, with all the delivery apps. They have all of that built in with integrations. And Wix is highly customizable. They control everything. They have excellent customer service. They help people whenever they run into issues. They have a ton of people waiting to help them out. So the question of whether or not this is a relevant product and will become more relevant, I think is a big green check mark. I think that this is definitely in a relevant industry. I think the amount of online web presence is going to grow dramatically over the next couple of years. The total addressable market right now is estimated to be just multiples and multiples and multiples bigger than Wix. Another thing we can consider is if the company's founder-led. Wix is a founder-led company. The same people that started it in Israel are still running it, and they are incredibly good. They've done a really good job so far. They've compounded the company at an incredibly good rate over the past 10 years. They IPO'd in 2013, and the compound annual growth rate since then has been 37%. So they've done a very good job, and it's the same crew running it. The same guys that started it are running it today, and this is their focus. This is what they're doing, is building this one company. Another big thing that I consider is the marginal cost of replication and whether or not that's very low or very high. And what that means is how expensive it is for Wix to continue to grow and add on more customers. How scalable is this company? If I look at a company like Costco, Costco's a great company, but it doesn't necessarily have a low marginal cost of replication. Because if you want to replicate Costco and replicate it over and over again, you can't just have more and more customers come to the same warehouse. They max out at around 60 to 70,000 on average in the US. And so in order to get another 60 to 70,000 members, you have to buy a big plot of land, very expensive. They're usually right in the middle of a city. You have to construct a giant warehouse. You have to hire staff and train them. You have to figure out logistics. You have to figure out all this stuff that's time consuming. It's expensive. It requires a lot of CapEx spending. That's to have the marginal cost of replication for Costco, which is very high. It's very expensive for Costco to continue to replicate. Compare that to Netflix. When Netflix gained 40 million subscribers in 2020, how much did that cost the company? Almost nothing. They didn't have to do much more marketing. They really didn't spend a whole lot more on marketing. They didn't have to hire any more employees. The servers, I guess, were a little bit more expensive. They probably had to spend a little bit more servers to serve all those new customers, but that is a very low marginal cost of replication. When I look at Wix, this is a software company, SaaS. The marginal cost of replication with Wix is incredibly low. They can gain 1,000 new customers, 10,000, 10 million, and it really wouldn't cost them a whole lot more. They'd just be paying for additional server space. Now, the other things that I look at is the network effect, which is, does each additional user add more value to Wix? I don't think so. Facebook has a strong network effect. All the users create all the content. They add the value. I think that YouTube has a huge network effect. Every single video that's uploaded adds more value to the platform. It keeps people on the YouTube platform. Wix does not have that. Having more customers, I don't think adds a whole lot more value to existing customers. Do they have a flywheel? A loop of self-reinforcing aspects of the business? Again, I don't really think so. As they get more users, they can get more data to determine future business decisions. That's a pretty weak flywheel, in my opinion. Nothing like what Netflix has or Amazon. So you're not getting much of a network effect. You're not getting much of a flywheel with Wix. And then we can also ask the question about moat. Does this company have a moat? In my opinion, again, I don't really think so. They have many competitors. It's a fiercely competitive industry. Shopify is the go-to competitor to Wix, but I actually think that they're not the biggest competitor because Wix and Shopify, they're not really trying to take marketplace from each other. Shopify is focused firmly on e-commerce. Wix is focused on service-based businesses. They're completely different, and there's a huge market for just service-based businesses. We have Squarespace. This is a competitor to Wix. And then we also have Weebly. This is purchased by Square, so they own it. It's another product that's very similar to Wix, another competitor to them. And then we have the actual biggest competitor right here. This is WordPress. They own 60% of this market. Wix owns 2% of it. So does Wix have a meaningful moat? I don't think so. I think at the very best, they have a very weak moat. And I think their biggest opportunity to grow is to steal market share from WordPress and convince people that this is an easier, better solution than trying to do all of it yourself on WordPress. Now moving on, I want to look at some of the technology and what this product can actually do, because it is a lot more than just a WYSIWYG. Here's one little short snippet of their technology.
Question: would you build a website for a major brand with more than 200 million users using Wix? Well, we did. Hi, I'm Sivan. I'm an R&D manager here at Wix. Today, I want to show you how we use our own platform, creating some pretty complex functionalities that may surprise you. First, all of our web pages are built on Wix. They get a huge amount of traffic. Users that sign up to Wix come with all kinds of needs and goals. So to match them with the best solutions, we built an onboarding flow on the Wix editor using custom code. We also embedded a web component using the custom element feature. These can be developed in any client-side technology like React, Angular, Vue.js, your call.
So not only is this good for pre-built templates and very easy static websites, but this is an actual solution if you want a better version of a even customizable programmable website where you actually have a developer, but you want a better order for being able to deploy and upgrade your website. And so it's a little bit more advanced than something like Squarespace. Squarespace has a lot of really beautiful templates, but Wix is far more adaptable. You can actually do more customized builds. You can actually drag things in more customizable ways. So the advantages of Wix over competitors like Squarespace and Weebly is that Wix is far more customizable, and I think it supports a wider variety of different types of businesses and websites.
So what now? Push to production? Well, not just yet. That's where the Release Manager comes in handy. It's a built-in tool that allows you to gradually roll out new versions and test them safely. What about SEO? Go ahead. Google Website Builder, create a website, or any of the other 3,500 highly competitive non-branded keywords we compete for. Security? Done. No compromising there. Our whole business depends on it. So let's put it this way. You can do everything with Wix. See for yourself.
So that's a quick look at the overall business. I think Wix is a good company. Is it one that I feel like I have to own, that I'm willing to pay a huge premium for? Probably not, because it doesn't have much of a flywheel, a network effect. It doesn't have a significant moat. It does benefit from a large total addressable market and a very relevant product. So I am positive on the company. I'd like to own it. Now we can look at some of the numbers to see if it makes sense. The first thing we can look at is the company growing? The revenue growth of this company is staggering. Since 2013, it has a compound annual growth rate of 37%. Since 2013. And then that hasn't really slowed down a whole lot. Last year, in the trailing 12 months, it's 35.6%. So they are compounding their revenue very quickly, and they're expecting to do that in the future. If we look at the revenue, where does this come from? Is it very vulnerable revenue? Can it be disrupted easily? Not really. The revenue is mostly, 85% of it is highly predictable subscription revenue from a subscriber base where the net revenue retention rate is 113%, which means that out of their current customer base, they're expected to earn more next year from those current customers, not even adding in new ones, than they did last year. Those customers are going to be paying them more, not less, which is a very positive thing when you're looking at subscription companies. Now, if we look at the breakdown of revenue, the blue category here is the subscriptions, and the red category is everything that is non-subscription, like payment processing. Looking at just the subscription business, it is highly predictable, growing every single quarter. This isn't annualized, this is every single quarter. If we look at the business solutions, it grows a little bit more sporadically, but it's growing every single quarter nonetheless. So every aspect of this business is growing. We look at some of the numbers from their most recent earnings report. They have currently a similar business model to Spotify, where they have a huge pool of free users. So this massive pool of free users just hosting their free website that currently is 210 million. And then like Spotify, what they do is they're constantly trying to convert those free users into premium subscribers by offering them some features and little upgrades and getting them more used to the service, trying to offer more and more value. And they're doing that very quickly. New premium subscriptions from free traffic sources is up 50%. And they're expected over the next 10 years, just based off their existing subscriber base, because they know the data, the analytics of churn rate and how much they can make, they're expected to make $15 billion over their existing subscribers, which is pretty incredible. Right now, the company has 5,600 employees, so it's a well-staffed company, and they have the huge majority of their revenue from that highly predictable subscription revenue, $967 million per year. And the percent of revenue outside of the US is 42%, so they have geographic diversification in their income source. Now, if we look at the actual PE ratio, currently Wix has a negative PE, so it's not even applicable. There's really no number you can put to it. For the next 4 quarters, they're forecasted to have negative earnings. And I know that this is a huge red flag for value investors, even for Wall Street, when they look at this and say, are we really going to buy a company that has negative earnings, has a negative PE ratio? I think what's important to realize here is that they could have positive earnings at any point. The company could have their earnings be positive anytime they want. They willingly choose not to because they dump money into marketing and they get such a good return on marketing. Look at their net income over the past few quarters here. You can see it drop more and more into the red here. They're just spending money and they're spending it on marketing. And you can see huge amounts of increase in their negative net income. It went down to $120 million in Q1 of 2021. The reason they did this was because they saw an opportunity. With the coronavirus and the pandemic, the management realized that this was a significant opportunity to expand their market share, and they went for it. They went for a huge amount of spend. It made their numbers look worse, right? They spent a lot more on marketing than they were anticipating, and it paid off huge. Now they're relaxing their marketing budget because the economy is opening back up. Not as many people are creating websites, and the management pulled back on marketing. This is a management that isn't concerned about Wall Street. They're concerned about growing their business and spending their marketing budget as efficiently as possible. To give you an idea of the efficiency of their marketing budget, take a look at this. This is their efficient marketing based on TROI. That's the time to return on investment, or in this case, on their marketing investment. If they invest money, they get into marketing. If they invest money into marketing, they get 60% of it back after 2 quarters. So in 6 months, they get 60% of it back. In 6 quarters, a year and a half, they get 1.7% back on their marketing spend. After 10 quarters, they get 2.4. After 14 quarters, they get 3.7. And after 18 quarters, they get 5.4 times. So if you're looking at this and you're the management of Wix, you can either stop your marketing budget and make your numbers look great, and you'll have a positive PE ratio, and Wall Street will love you because your PE is now positive, but it's low and you're a profitable company. Or you could pile a bunch of money with very cheap debt into marketing and make multiples on your investment over an 18-quarter period, 5.4%. In literally 6 quarters, a year and a half, they make 1.7 times their marketing spend. They make back their marketing budget in 1 year. That is an incredible conversion and an incredible return on their investment. And that's because they do this so opportunistically. They look for different times and different opportunities to take advantage of their marketing spend. If I'm looking at this from the management perspective, I think they're doing the right thing by continuing to spend heavily on marketing and not worrying about what Wall Street thinks and what the numbers look like. Because right now they're getting such a better future for their company by spending this money and seeing the rapid return on their investment. Now, if we actually look at their balance sheet and compare their assets to debt, their total assets right now is $1.3 billion. So they have $1.3 billion in total assets or short-term investments. And then their total debt right now is $1.8 billion. So they have $500 million in debt, in net debt that they couldn't pay off with their current assets. And this went up quite a bit over the past year because they saw this huge opportunity to take out cheap debt and pour it into marketing. And I think they made the right move there. Even though this makes their balance sheet a little bit weaker, the return on this investment and how cheap it is to get capital right now, I think was worth it. And then as I pointed out before, this company has always been free cash flow positive, and they currently have free cash flow per share of like 26 cents. So it's gone down a little bit, but even being in the positive with free cash flow, I think is pretty incredible for a company that spends over half of its revenue on marketing. Literally half their total revenue is spent just on marketing, and they're still free cash flow positive. And then one other thing I like to consider with every company I look at is their shares outstanding over time, whether or not the number's increasing or decreasing, whether or not they're issuing more shares, diluting shareholders, or they're doing buybacks and creating more equity for the shareholders. As with most new tech companies or most smaller tech companies, they almost always have share dilution. They don't have share buybacks until they become a big profitable firm. So right here in blue, we have Wix's shares outstanding over time. You might notice the trend. It goes up over time. They're diluting shareholders, probably to pay for their staff with stock options and compensation packages. We compare that to Apple. Look at Apple's shares outstanding over time. When Apple realized they had way too much money, they don't even know how to spend it, they thought, we'll give it back to the shareholders. So they're buying back their shares aggressively, which makes every share that I own of Apple become more of the company overall over time. So this is usually viewed as a very positive thing. When I looked at Apple, I saw this and I thought, man, even if nobody else buys Apple, Apple's going to buy more and more of Apple. They're spending aggressively buying back their own shares. Well, the opposite's happening with Wix. Since about 2017, they've increased their share count like 60%. So the shares are definitely diluting the shareholder over time. And that's something to consider. I think they're likely to continue doing this as it's probably a way they pay all those developers. And then lastly, the company currently has a $13 billion market cap. The trailing 12-month revenue multiple, this is something I also look at, it's the price to sales is another way of looking at this, is 11.3. Just to give this some context, right now Shopify's trailing 12-month revenue multiple is like 48. So Wix on a price to sales basis is around 4 to 5 times cheaper than Shopify. And obviously Shopify is kind of the chosen one of all the website builders and e-commerce platforms. But that just gives you some context. Wix is significantly cheaper than Shopify based on a price to sales basis. And with a $13 billion market cap, it's rare to find a company that has this much revenue, this many users, and I think this much potential trading at that low of a market cap, especially when the majority of its business is highly resilient subscription-based businesses. They usually trade up very quickly. Like if you look at most subscription-based businesses, they'll have market caps of 20 billion, 30, 40 plus. So those numbers I think look decent, not amazing, but I think they look okay. Now, if we look at the margins, the gross margins of Wix are 61%, which are very good. That's right where they should be for this type of SaaS software company. Microsoft's is right in the same range, like mid 60%. Then we have the other margins, which are not quite as good, nowhere close to Microsoft's. The profit margin is 12%. That's very low and only for one quarter. Not very telling in my opinion. Then we have the operating margin at negative 22%, and it's hovered around that point for the past year or so. Now, what I'll say is this, again, this is another sticking point for value investors looking at this saying, this company must be a bad company or a weak company because it has negative operating margins, right? The profit margins have largely been negative. That's not necessarily the case. If you go back and look at Netflix's operating margins, in 2016, they were like 2%. On just that basis, the company would look incredibly weak. But what was Netflix doing? Netflix was reinvesting back in their business. They were more focused on growth than squeezing profits. And I can guarantee you the management of Wix is very focused on the same thing. Future profits over profits right now. That's what they're focusing on. They want to gain market share. They want to grow their company scale, and then they'll have the benefits of scale and cost structure. They'll have a lower cost structure on a per customer basis. You can look at the operating margins right now of Netflix, and they've went from 3% in 2016 to 20% right now. They're like 22% right now. So when Netflix got to the point where they thought we have big enough scale, now we can push up the operating margin. And that grew steadily. It's growing 3% per year. So what do I think of the stock overall? In summary, I think the business is great. It has a good leadership. They're executing well. They make good decisions focused on the long term. They have a good product. I think it has a lot of future relevance. I think it will become more relevant over time. The biggest downside for me with Wix when I consider this investment is the lack of any type of moat. They offer nothing, I think, truly unique to their company. Every company that I invest in, most of them at least, have something very unique about them that other competitors have a difficult time replicating. With Wix, there's multiple competitors like Squarespace and Shopify and Weebly and WordPress, and they all essentially do different variations of the same thing. So that's a huge downside with this company, is the lack of any type of unique product or moat that can't be replicated by another competitor. And if I'm looking at a company that has no big moat keeping competitors out, I want to pay a cheaper price for it. Simply put, I'm not going to pay as much of a premium for a company without a moat than I would with one with a moat, with something unique. With a company like Disney, when they own Marvel and Star Wars, that is a very unique moat. You can't replicate those type of intellectual property. So I'll pay a little bit more for a company that has something like that than one that doesn't. And with Wix, I can see that this company's trading with a lot of enthusiasm. It has a price to sales of 13. It's not as much as some other tech companies, but it's more of a commodity than a lot of other tech companies. Again, the lack of a moat, it's a little bit easier to replicate. I can see that in 2020, the price went up 65%. And I don't know if this huge surge in stock price is really justified. So I'm going to put Wix on the watch list. And if it comes down to a cheaper price, I'll buy into it. If it comes down back into the 2019-2020 range, I'll be buying into the company because that gives me a little bit more margin of safety and I'd feel a little bit better buying in that range. But I'm not going to pay a premium for a company that really doesn't have a moat to speak of. I just don't think it deserves it. So this could perform well. Maybe it will take off to the moon. But as of right now, I'm sitting this one out. I hope you enjoyed this analysis. If you did, make sure to subscribe to the channel and I'll see you in the next one.